8.7%. That is the starting dividend yield right now of Six Flags, ticker symbol SIX. I am going to share my analysis of this dividend stock today, and also 4.7%. That is the starting dividend yield of Carnival Cruise Lines, ticker symbol CCL. I am also going to share my dividend stock analysis on that stock as well. You all have been asking me on my Facebook group, on Twitter, here on YouTube. You have been asking me, Ian, what do you think about these two stocks? These are hot dividend stock picks. At least that's what a lot of people think right now. Others think they're not hot, they're cold dividend stock picks. We'll talk about that. I'm going to go through my analysis today, fundamental dividend stock analysis on these two stocks. I have a lot to share. Both of them are in the general industry of entertainment, travel, and leisure. These are companies that provide entertainment and leisure relaxation to people all around the world, and so I'm excited to share that. And also, I have two dividend stocks that I purchased this week that I have not shared on my Twitter. I've been really busy this week. I also felt like I was already tweeting quite a bit, so I didn't want to tweet too much and overload the Twitter feed, so I thought I'd just share these stocks that I purchased in the video today. And I purchased Royal Dutch Shell, and I locked in a 7.2% starting dividend yield, and I purchased more shares of Wells Fargo. I actually purchased those today at a 4.3% starting dividend yield. Those are two hot stocks in my humble opinion as it pertains to my personal dividend stock portfolio. It is Friday night. I am really tired. I've been driving all over California today as part of my job in real estate, but you know how we do it around here on PPC, Ian. I can't stop, and I am up late filming this video for all of you. I hope you enjoy today's video. All right, everyone. So I'm going to start with Six Flags. I want to share an insight before I even start with my analysis today. And my insight goes like this. You know, I own 43 dividend stocks, and there's certain stocks that are kind of like evergreen, like they rarely go on sale. They're just these perfect companies that never have problems, that just go up and to the right. And I would say a general example of a company like that is PepsiCo, ticker symbol PEP. And I'm jotting this down, by the way, for my disclosures later. But there are other types of stocks. More often than not, stocks are not like Pepsi. They have problems from time to time. Wells Fargo is a good example. Wells Fargo right now has a problem or two. The stock is down. It is presenting a value, in my humble opinion, and that's why I am building my position right now. Another stock like that was AbbVie. AbbVie, ticker symbol ABBV, one of my favorite stocks that I was purchasing all the way down in the 60s. They had really good earnings today, and it's skyrocketing again. But for a while, they were down on their luck. People were worried about the Humira patent expiration, but that was before the Allergan proposed merger. And honestly, a lot of those lower share prices was before some of the promising FDA approval on the Skyrizi drug. Anyways, AbbVie got past it, soaring to new heights. So there's kind of, I'm trying to paint a picture here, two types of stocks. There's those dividend stocks that face hard times, that present value from time to time, and there's those dividend stocks like Pepsi that sometimes they provide value, but very rarely. They're just up and to the right. They're always priced to perfection. But anyways, you start looking at something like Six Flags, and Six Flags obviously falls into the bucket of there are some things wrong. But I'm going to tell you off the bat, I like buying stocks when there's maybe one thing wrong, because it's easy to fix one thing. And when one thing is wrong, usually there's some value to be had. You can buy at a good value price and lock in a really good starting yield, and be a value investor. And that's just what I am a lot of the time. But when there are too many things going wrong, too many things, sometimes it's not a value. Sometimes it's a yield trap, or it's just a turnaround play that is going to take a long time to turn around. And so My concern with Six Flags is it's not an AbbVie. It's not a Wells Fargo. It's something that has more problems. There's a few problems at once happening with this company, and it may be that it's just a little bit outside of my wheelhouse because of that. I'm not a turnaround investor. I'm a value investor. I'm a dividend investor. I'll buy when there's one thing wrong and the stock is down because of it, but I see the company getting through that one thing pretty quickly. But when there are a lot of things wrong, and it's going to take years and years to get through that, if ever, that causes some concern for me. And so I just want to paint that picture, share that philosophy to begin with, because that's how I am looking at Six Flags. And quite frankly, Carnival, to be honest as well. And so let me pop some numbers on the screen. I'm just going to start with the high level stuff as it pertains to Six Flags, as I always do. I was on the road earlier today, and I actually wanted to film this in the car. I wanted to do another ride with me like Nelly video like I did a long time ago, but I got too tired, and so I was at Starbucks for hours preparing for this video, and then I had several hours to drive home. Now I'm home. Now I'm doing it. Anyways, let's look at Six Flags. Price per share is $38.14. The dividend annualized is $3.32. That puts the starting dividend yield at 8.7%. Mind you, for comparison purposes, I own a stock called Cedar Fair, ticker symbol FUN. The starting yield right now is in the high 6% range. The high 6 is just below 7. And so this is yielding a good 1.7% higher. That being said, Cedar Fair does have better tax implications because it's an MLP. Although it's harder to do your taxes because you get a K1, it's more confusing. You have to be more sophisticated to get through it all. But there generally are some tax benefits of the MLP structure versus the corporation structure. But Six Flags, you get a higher yield. Corporate structure, just want to share that for comparison. But putting aside company structures, the starting yield here on Six Flags is higher. And rightfully so. There is stuff going on with this company that you just don't have to worry about with Cedar Fair, which is just centered on North America, and their business in general is faring pretty well, although time will tell. Okay, the payout ratio on Six Flags is irrelevant. Most people would say, oh, they can't pay their dividend because of this payout ratio. Keep in mind, with this general industry of companies that are related to real estate, they are related to amusement parks or cruise ships, hotels, payout ratio is meaningless because GAAP EPS, which dictates payout ratio, includes depreciation of assets. It includes that depreciation as an actual charge. And so the EPS can be very misleading. For these types of companies, instead of doing that, what I like to do is look at the cash flow statements. And I like to look at free cash flow. I like to back into free cash flow by looking at the operating cash flow, taking out capital expenditures, because there really are capital expenditures, taking out dividend payments as well, and understanding what's left, if anything, after paying dividends. We're going to do some of that analysis later. It's really important. But keep in mind, payout ratio for a company like this, irrelevant. But most people off the bat would look at the payout ratio and just dismiss Six Flags. Not me. All right. I have the PEs in here, but honestly, I shouldn't. These PEs are literally irrelevant, again, because of depreciation and how it can throw off GAAP EPS, which in this particular industry is a case where clearly GAAP EPS, for me at least, isn't very meaningful. It's all about the cash flow. Dividend growth, it's been good. They've been raising that dividend rate on average for the last 5 years by 9.8%. In fact, I was looking at their earnings, and not this year, but I think it was last year. It was recently, in one of the recent quarters. I think it was actually probably Q3 or something of 2018 or Q4 of 2018. I don't remember, but they had all-time peak in revenues. The company is doing really well. And so the company is now, I'm gonna give you a preview. They're falling on hard times right now. They're falling on harder times. And yes, they did just raise the dividend. And so I'm going to show a screenshot here of that as well. It was a smaller dividend increase, but they did just raise the dividend. And they raised it to 83 cents a share, as I had already discussed. And it was a very small dividend increase. I think it was just by 1 penny, if I can remember correctly. In fact, I want to check that right here just to make sure. People ask me actually sometimes how I check the dividend history. One very quick and easy way to do so is just to look it up on Google, which brings up the NASDAQ.com website. And NASDAQ, I've always seen, has very favorable and accurate information, more or less. Sometimes it's off for ADRs that have an ADR fee associated with them. Like I look up Royal Dutch Shell on there and it can look a little wacky. But for most companies, NASDAQ has very good information. Anyways, while I was talking here, I looked it up. And yes, it is in fact true that they raised the dividend just by 1 penny. And so the reason I want to mention that, again, is they raised it recently, back in November, but their confidence, obviously, in raising it is not as strong as the last 5 years, because the average growth rate over the last 5 years has been a staggering 9.8%, and that is just not sustainable. And so what is going on with this company? Why is it priced the way it is? I want to talk about that. They issued a fourth quarter warning. They have not announced their fourth quarter 2019 earnings just yet. It's just around the corner. We should keep our eyes on it. They're going to announce this on February 20th. But they said, hey, we're going to miss our earnings, and we're going to miss, well, they didn't say earnings. They said we're going to miss on revenue. Revenue is going to be light. It was weaker revenue than expected. And I think the earnings forecast, that earnings warning, was mentioned that in their North America business, in fact, is facing weakness. And so that being said, as I mentioned before, I forget what quarter it is, but they just had a record. And so, yeah, if they're coming off the record and they're facing a little bit of weakness, look, no business just goes straight up and to the right. There are peaks and valleys. And as long as the peaks keep getting higher and the valleys keep getting higher, I don't mind a little bit of fluctuation. And so off the bat, when I hear something like this, hey, Six Flags, we're warning, earnings aren't going to be as good, revenue's not going to be as good as we were thinking, well, that's that one thing, as I was just mentioning. If one thing is wrong, like one thing was wrong for AbbVie when I was buying in the 60s, like one thing is wrong with Wells Fargo right now, it's a company in transition. Well, fine, I'll typically be very interested. My interest will be piqued. However, I read on in their announcement that said they were going to have a horrible Q4, and this is what scares the heck out of me with this company. They said, hey, we have a partner called Riverside Investment Group, and they are defaulting on their obligations to us, financial obligations. And it just so happens that, why is Six Flags partnered with Riverside? They're partnered with them to develop theme parks in China. And I looked, how many theme parks are they developing in China? 3 of them. And I looked on their website. They had photos of the construction progress. How far along are they with these theme parks? They're pretty far along. There's a lot of work that has gone into them. Look, I'm a commercial real estate developer, and one of the risks, if you will, with development, one of the greatest times when someone could face risk is during that construction period. It's like, once you start in that, you better finish. You better get through the construction. You got to do it. And so if they are announcing here, Riverside is facing challenges, they're defaulting on obligations, we don't know about the future of these 3 theme parks we're building in China right now that are pretty far along, that we've already sunk a bunch of money into, that we're already on the hook for a bunch of money. Boy, is that a red flag. That's a huge red flag. And so for me, even without going further, look, if they were just saying, hey, we're going to miss on revenues in North America, attendance is weak, our theme parks in North America aren't doing as well, I can get past that, because honestly, like I said, higher peaks, higher valleys, they'll figure it out. But now that they're also saying Riverside Investment Group, our strategic partner, is defaulting on obligations that they owe us, we've got these theme parks we're building in China, and they are, at this time, we don't know if they're going to be finished. Oh boy, that is risky. And so Here's some homework actually for the group. I did some digging, and so I looked in their quarterly report, I looked at their annual report, and I just searched Riverside Investment Group, and I searched on the keyword China. I couldn't find anything. And so one of the things about publicly traded companies is sometimes if something is kind of a newer initiative or it's a subsidiary or it's smaller, it's harder to find information about it sometimes because these companies, honestly, they can hide certain things. They don't have to expose everything. Maybe they don't want to expose everything for competitive reasons. They don't want their competitors knowing stuff. And quite frankly, I'll tell you, let's rewind a few years when they decided to get into this China stuff. I think it's a brilliant idea. China is one of the fastest growing economies in the world. It's actually forecasted that China, India, and Africa are going to be three areas of growth, three incredible areas of growth for investors. And so off the bat, looking, if it were a few years ago and they told me, hey, Ian, we're going to build some theme parks in China, I think that'd be a great idea. And so it may be that there's not a lot of reporting on it because, quite frankly, they don't want their competitors to know what they're doing. But fast forward to the present day in 2020, there are some challenges that they're facing. And what they're citing is a softness in the real estate market in China. And they're also, I imagine, with this coronavirus, there's probably some challenges there that are happening even after they announced this warning, this earnings warning. And so here's the deal that I kind of look at with this whole China thing. If they can weather the storm and figure it out, get these parks built, I think that there's such huge upside in China over the long run because everything I read, everything I hear is that there's now this emerging middle class in China. And this middle class is going to want to have experiences like this to enjoy themselves at theme parks. And so I think it's a no-brainer. I think it's a huge opportunity. But it may be they never get there. It may be that they just can't weather the storm and they lose these properties and they lose a lot of money at it. And so let me tell you something else. Here's another way of looking at it. I own a stock, Altria, ticker symbol MO. They're facing some challenges because they paid a bunch of money, upwards of $10 billion. I think it's 12 billion range or so to buy a stake in Juul. It looks at this point like they will be, if in the worst case at least, writing the whole thing off. They just basically threw away all that money. And in addition to that, they exposed themselves to lawsuits. But what is miraculous, and I shared in my last video, or one of my last videos that I'll link to in the description below, this company, Altria, they can weather the storm. That's how strong of a company they are. They can weather that bad of a storm. With this China thing with Six Flags, I'm just saying, based on my reading so far, which isn't much, I don't know if this company can weather this storm. 3 theme parks, half built, walking away from having debtors coming after them because they owe money on their construction loans, this and that. That ain't good. And so here's the homework. If you know more about this than me, as a community, I'd like to dig into this because I did the digging I could at Starbucks on the road, between meetings, during my workday today, to get this video done in time. But I couldn't find anything about Riverside Investment Group. I couldn't find anything about how it's structured. Like, who took out the debt, for example? Is Six Flags on the hook for the debt for building these theme parks? Or is that all on Riverside or someone else? The key here, if you own Six Flags, you got to figure this out, in my humble opinion. If you don't own Six Flags and you're thinking about getting into it, I couldn't imagine buying this stock without having these answers. And so what I want to do as a community is just put some homework out there. It would be so interesting to understand, am I blowing this out of proportion because Six Flags, they're not really on the hook? Riverside is, and Six Flags has the kind of upper hand in that relationship. Or Six Flags is the one that's totally on the hook because they're the ones that took out the loans, took out the debt to build these theme parks in China. And they're going to have to repay it, whether they get built or not. They never open the gates. They never have a customer step on property. They're on the hook for that money. And so that would be so interesting to get to the bottom of. And then it'd be interesting to get to the bottom of what's the magnitude of the debt that's related to that. What are they potentially walking away from? So on and so forth. And so that's where I'm at with Six Flags. But for me, I can kind of cross it off the list now because I feel safer with Cedar Fair. They don't have these China problems. And like I said, when I do value turnaround type stuff, it's usually a world-class company that has one problem, not a multitude of problems. And so I want to look at cash flows right now because this is important too. So I'm going to pop it on the screen. The first thing I looked at was their Q3 report. And the Q3 report basically showed year-to-date cash flow. And again, I'm just looking at cash flows here because EPS, GAAP EPS is so misleading. And so you can see they start with net income at the top. But then they start factoring out, for example, depreciation and amortization, which was 89 million. It's a huge, huge number. And so there's a lot of depreciation that was just skewing the GAAP EPS. You kind of go all the way down and you get cash, net cash provided by operating activities. It's 341 million versus 342 the 9 months in the comparable period before. Now we move on and we look at cash flows from investing activities. This is important because you can see here, there's a line item that says additions to property and equipment. This is real. This is capital expenditures. This is money they have to pay to maintain and upgrade their roller coasters. And so, whereas we benefited by getting back some depreciation, or a lot of it actually, we certainly lose out here. By the way, moving back up, it also looks like they're doing some kind of accounts receivable and such adjustments. They're adjusting here, in my opinion, if I'm reading this right, for changes in working capital. That's probably what's going on above there as well. But I'm trying to go quick here. But again, you see some huge CapEx there. And then I move down to financing activities. And under financing activities, they had to repay a bunch of borrowings, but they took on a bunch of borrowings, so it kind of wipes each other out. But you see a huge subtraction there for dividends, 208 million plus in dividends. You go all the way down to the bottom, not all the way down, but close to the bottom where I have the arrow, and it basically shows the net increase or decrease in cash and cash equivalents. And look, lo and behold, 2019, even after dividends, the cash flow, free cash flow, this is more than free cash flow because it's after dividends. Free cash flow is typically before dividends. They got something left over, and so it looks really promising when I looked at this. But don't get too excited yet, because this is a seasonal business, and seasonal businesses do these types of business. Amusement park does really well in the summer. Some of these parks, a lot of these parks, they're not even, I'm not positive for Six Flags, but I know for Cedar Fair, they're not even open year round. They're only open certain months and weekends of the year. And so what I did is I was like, hey, Ian, wow, if they've got that much, my gut told me they got that much cash flow after paying dividends, and they're going to announce some weakness in earnings. Say they didn't have the China problem, or as a community, we did the analysis and the China thing's a non-issue. I don't think it is, by the way. I think it's a big issue. But maybe there's something there, to be honest, especially with the high starting yield. But I'm showing you this first on purpose because this is how numbers can mislead investors. As a fundamental stock analyst like myself, it is so important to keep digging, to not give up, to keep turning over different stones. Because what I did after this is I was like, okay, I only have the first 9 months of 2019 and 2018 as well in this report. And it shows for 2018, actually, they were negative cash flow, but only slightly. And that's after dividends. So I was okay with that, basically break even. But 2019, good. But I knew from my experience, and this is the thing about being a dividend investor, fundamental dividend stock analyst, the more of these you do, the more comfortable you become with different industries. Anyways, I kept thinking, I've done this analysis before. I've looked at this for Cedar Fair. I know it's a seasonal business. And so I'm like, you know what, Ian? I need to look at the 2018 annual report. And I know, for example, that it doesn't include 2019. It's only 2018, but it'll give you a better indication of what the real cash flow is. And so I'm going to pop this on the screen now. And this is the same statement of cash flows, but it comes from the 2018 annual report. And now it shows the full year, not just the first 9 months, the full year. And you can see the magnitude of the loss, it gets bigger. And so you'll recall from the previous screenshot, they lost some money in 2018 all the way after paying dividends. But you could see here all the way at the bottom, they lose about, I would say, $20+ million more. It's a bigger loss. It's I don't recall, I don't have the other screen open anymore, but it's the magnitude of the loss increases. And so what these statements of cash flow show me is that when 2019 earnings come in, put aside the China thing, even though the cash flows from the first 9 months look kind of good and we look good on the dividend, this and that, when the Q4 numbers come in, I expect just on North America business alone, cash flows to possibly swing negative. And that's after paying dividends. It could go negative, meaning it's not sustainable. On top of that, you throw in the China thing, it worries me. And so that's where I'm at with Six Flags. It's not the right stock for me. I'll tell you another way I look at it. I can buy, let's just look at a completely different industry now, oil. I can buy Royal Dutch Shell right now. And in fact, I did buy Royal Dutch Shell this week. And what was my starting dividend yields? 7.2%. So I can get 7.2%, and in my opinion, that's relatively risk-free. Royal Dutch Shell, quite frankly, in my opinion, it's kind of like investing in a bond. I'm not going to really win a bunch of capital appreciation there, but I think that dividend is pretty strong, pretty solid. I'll get more into that in a minute, but 7.2, I wouldn't say risk-free because all of this carries risk, and this is what's so important. Disclaimer, everyone. I'm just sharing my personal journey here on YouTube for fun and entertainment. Investing carries substantial risk. And so when I say relatively risk-free, I'm talking about the way I look at things from my personal journey. But as far as what I do goes, I don't think Royal Dutch Shell is a huge risk. I think the dividend is pretty solid. I don't think the dividend is going to grow much. I don't think the stock is going to appreciate too much. But I got my 7.2%. And now you tell me here with Six Flags, I can get another 1.5% on top of that, but I got to take on a faltering North America business and potential negative cash flow after dividends. And I got to also take on the fact that they're just in a horrible predicament in China, which is so unfortunate because to me it looked so promising. And hopefully they can make it through that. It's just too much for me. I'm just not going to take another 1.5% yield when I can get it with less risk. I can get a 7.2 over at Royal Dutch Shell. Or quite frankly, if I need to be in the amusement park space, go with Cedar Fair, which I don't think has a lot of risk compared to Six Flags. I get there about 1.7% less of a dividend, but I do get more tax advantages. I'll just go with that. It's just not worth the extra yield for the risk. And so that's where I'm at with Six. But share your comments or in the comment section below, your thoughts. Like I said, this is the first day, literally, I've been looking at this thing. And so I'm new to it. But that's how I look at these stocks quickly. And you have to be quick. There's so many stocks to look at. I have to get to the bottom of things quickly, and I just don't feel comfortable. So that's that. I want to share Carnival Cruise Lines now, which in general is a more promising stock in my opinion. Before I do that though, by the way, I'd be curious, put in the comments below. Maybe I'm biased because I have another community question. The China stuff, put it in the comments below. But the other one is Six Flags. How many of you out there go to these theme parks, and what do you think of Six Flags versus Cedar Fair? Personally, I think Cedar Fair is more of a wholesome experience. Whenever I've gone to Six Flags parks, I'm just saying you got kind of sometimes a more rowdy group. Sometimes, for example, you may not feel as comfortable like at a Six Flags park at nighttime as maybe you would at something like a Cedar Fair park. At least, maybe I'm totally biased here, but that's just because I own Cedar Fair and just from the experiences I've had. But that's just another subjective factor. While I was kind of against Six Flags from the beginning, for me, I like going to their theme parks sometimes, but honestly, with 2 kids and wife and being a family, I just don't feel it's as much of a family environment or as much of kind of a wholesome, safe environment as some of the Cedar Fair parks. But I'd be curious, what do you think? Maybe I'm wrong, and maybe it's my subjective kind of biases pushing me one way or another on the stock as well. I'd be curious what you think. Anyways, got to move on to Carnival Cruise Lines, ticker symbol CCL. I'll tell you off the bat, I don't want to be in this industry. This is how I do it. I'm going to go through the numbers. Don't worry. And the numbers are quite a bit better than Six Flags. So if I had to buy one, I'd go with Carnival. But I'll tell you, I just don't want to be in this industry. For me, I understand this general space. It's going to be capital intensive. There's going to be a lot of money invested, a lot of upkeep, so on and so forth. As long as that's going to be happening, I'd rather have it be in physical real estate. Now, there's going to be people come in and say, but Carnival Cruises owns hotels, this and that. Yes, they do. They got it all. But their primary business are these cruise lines, to my understanding. And cruise line, it's like an automobile. This is one of the great depreciating assets of our time. And so they are constantly replacing, upgrading, fixing, depreciating assets. That's where all this money, all these loans are going towards. That's just not something I want a part of. It's just not for me. For me, if I have a lot of loans being taken, a lot of debt being taken, and it's going towards physical real estate, like for Cedar Fair, for example, my understanding is last year, I think 2019, they bought the land from the city of Santa Clara that was underneath their Valley Fair park, one of the Paramount parks, I believe they acquired in Santa Clara, Greater Bay Area. Golden move. Hey, oh my gosh, that land alone, the value of that land, take the park down, put in a bunch of high-rise condominiums, man, we all retire on that. Now, their agreement with Santa Clara, I don't know if that that is allowed or not, but I'm just saying they own that land now. That is valuable land. Carnival Cruise Line, cruise ship, it's not worth nothing. And so even worse, look, my heart goes out to folks facing this awful coronavirus, and I am blessed to invest in companies like AbbVie, for example, that hopefully are going to go out and find a cure for this awful virus. But I'll just tell you, like cruise ships, the viruses spread on these things. Like, oh my God, people get sick. Now with these kind of problems, their cruise lines, they're going to have to dock them all and not run the cruises anymore. Again, maybe it's just my subjective biases and stuff, but I guess I'm just saying I'm not really a cruise person, but I'm not trying to hate on people that are. More power to you. But I don't know. I just kind of get cabin fever or something out there on the cruise, and germs and this and that. And but anyways, that's my subjective stuff. So let's just look at the numbers here. Take a look at all the numbers for Carnival. Hey, don't worry, it gets better than Six Flags. So Six Flags, maybe it's a hot dividend stock, but not for me. For me, it's cold. But Carnival, people think it's hot, gone down a lot. Maybe it is hot, but it's not for me for the reasons mentioned. Anyways, price per share, 42 and change. Dividend yield, 4.7%. Payout ratio is reasonable. It's only at 44%, and that is on GAAP EPS, which is even more amazing because, like I already said, GAAP EPS doesn't mean a whole lot with these things because it can be quite off for companies like this that are in this type of space that have a lot of depreciation. Although, it looks to be reasonable. PEs are down in the 8s for 2021, 9s for 2020. Not bad. They've been growing the dividend really fast at almost a 15%. I don't know. There's nothing I see very bad there with Carnival Cruise Line. And so for subjective reasons, it's not for me. Maybe it is a reasonable value. Let's look at the cash flows. I'm going to put that on the screen right now, so check it out. Here's actually, I'm glad I put this up because I didn't remember this until just now. This is something that did bother me a bit with Carnival, and I think maybe it's one of the reasons it's down. Let's just drop all the way to the bottom of their cash flows. And they have cash from operations. They have capital expenditures in here, which is great. So you can see the 12 months ended, I guess their fiscal year ends November 30th. 2018, their cash from operations was 5.5 billion. Their CapEx was 3.7 billion. Dividends were 1.355 billion. And so 2018, even after paying dividends, they netted, they made, or they had left over in terms of free cash flow, like super free cash flow. I guess I'll create a new name for it, because free cash flow is typically before dividends. But after dividends, they got this super free cash flow. They still got some left. So good job, Carnival. 2019, though, 12 months ended 2019, November 30th, they had this huge CapEx. So check this out. They cash flowed from operations 5.475 billion, so slightly less than the prior year, but CapEx was way up. It was up to 5.4 billion, so huge CapEx. And again, this is just a waste. Oh my God, they're putting $5.4 billion into these cruise ships that are worth nothing. Who's going to buy it? What's it going to be worth in 20 years? Nothing. Is that land in Santa Clara going to be worth something in 20 years? Heck yes, it will be worth infinitely more than it is now. Anyways, they paid the dividends, and so they lost $1.3 billion in 2019 after paying their dividends. Now, I want to pop the numbers back on the screen here that I just showed, because if we go back, we know from the cash flow analysis that they're losing money. But on paper, and again, to be fair, I'm looking forward here, but analysts are saying that they're earning $4.50 a share in GAAP EPS, because GAAP EPS doesn't include capital expenditures. Capital expenditures are investments, if you will, in the business, and they show up as an asset, if you will, on the balance sheet. And so these are two separate things. So GAAP EPS flows down from your income statement. Capital expenditures, investments in the business showing up as an asset, that goes on the balance sheet. What is beautiful about the statement of cash flows, especially as it pertains to this type of business, which is like a entertainment / cruise / vacation kind of thing, it marries the two. It marries the income statement and the balance sheet. And so you get the concept of CapEx into the actual operating numbers. And that's why I love this free cash flow concept. And then obviously free cash flow is after CapEx, but I like the super free cash flow because that takes the dividends out. That shows you what's really left in cash flow after everything. And so this is why sometimes I think some people might be thinking Carnival Cruise Lines is a better value than it is, because these numbers at a top line, just looking at an EPS type of analysis, just looking at like a payout ratio type of analysis, looks good. And don't get me wrong, hey, I commend them. It is reasonably good, to be honest. But you do some cash flow analysis, it ain't so good. It was great in 2018, but not so good in 2019. And so the question becomes, was that CapEx a one-time thing? Is it going to be a recurring thing? And so what I would look for, I'm not going to buy Carnival. I already told you why. But if I owned Carnival, or if I were looking to buy it, what I would do is I were building my position, managing my position, is I would look really hard on a quarterly basis at the cash flows, at the capital expenditures, and I would understand, does this trend from 2019 change, or is the trend the future? Goes back to what I said in the last video about one-time expenses as it pertains to litigation. A lot of companies now facing litigation, they're adjusting EPS because they're saying, oh, it's a one-time thing. I think 3M was doing that. But should we really be looking at adjusted EPS? Is that litigation really a one-time thing, or will it always be there? And the question for Carnival, are these CapEx one-time, or will it always be there? And for Carnival, the CapEx, it just drives me a little nuts, because it's all this money going into these ships, not even on improvements on land. And mind you, they own some hotels from my understanding, but again, it's these cruise ships, just kind of not for me at least. But that's what I would be looking at if I were taking a serious look at Carnival. And so anyways, I hope these are hot stocks, these two, Carnival and Six Flags, for those of you that own them. I wish everyone who owns them all the best. This is how I look at stuff. This is why I'm not buying these two, but I am a owner in Cedar Fair, ticker symbol FUN. And to be fair with Cedar Fair, is it's kind of like a Six Flags in their North America operations. I would say a little bit better. I don't think they're facing the slowness that Six Flags is. But quite frankly, when I look at their cash flow, they've dipped a little bit negative as well after paying the partnership distributions. And so I have my own things I want to watch with Cedar Fair. But with Cedar Fair, the way I look at it is there's one thing right now, one thing that's a little bit off, not a ton of things that are a little bit off. And so I'm willing to do it. And I will probably be accumulating some more shares sooner or later. All right. Before I end the video, I got some more stuff to share. I want to talk about my purchases this week. I'm so excited. I want to start and share some numbers. I'm going to start with Royal Dutch Shell. Let's start with that one. So I'm going to pop that on the screen right now. I'm going to go quick. So I'm getting tired. Friday night. I got to do this thug lifestyle. So RDS-A, price per share, $52.48. And dividend is $3.76, so I'm yielding 7.2%. Oh my goodness. Payout ratio 71.5%, and the PE is in the nines. It's going to go up to the tens because their earnings they're kind of flatlining. They're not expected to go up here, and so here's something I want to share. What's going on with Royal Dutch Shell? What's going on with all the oil stocks? Energy sector is cheap now. Coronavirus is facing, plaguing us. It's a horrible thing. My heart goes out to anyone affected by this virus, and my prayers go to the pharmaceutical companies looking for solutions. This is why I take pride investing in big pharma. A lot of people put big pharma down, but big pharma is out there coming up with solutions. The really, really amazing scientists, PhDs that work at these companies are working their hearts out right now to try and find solutions. And that just makes me feel good as an investor. I like backing that kind of company. Anyways, I'm going to pop this on the screen. Let's look at oil. WTI crude is at $50 now per barrel. Its peak in January was at 63. Brent crude is at 54, 53. Peak was at 68 back in January. And so what happens is oil is volatile and oil is going down now. Oil goes down, oil stocks go down. It's as simple as that. I like to buy oil stocks when the price of oil is down, when the stocks are doing poorly. These are trading range stocks, if you will. They long term, they should be up and to the right. But in general, even over a 10-year period or 15-year period, they're kind of in a trading range, up and down, up and down. And so I like to buy them where they're at the bottom of the trading range. For me, they're a proxy of a bond. I know what I'm getting. I'm getting my 7.2% yield. Is it going to grow much? Not really. Hey, I know BP, for example, just raised their dividend a little bit. But in general, I'm just saying these stocks aren't huge dividend growers. They are dividend maintainers. And so I'm going to link to this in the pinned comment below. By the way, I was reading an interesting study. A lot of people are fearful, and I did a whole video on this. I'll link to it in the description below. Oil's going away because the future's Tesla. Perfect week to talk about Tesla with all the crazy activity there. By the way, I'm actually really glad Tesla went up because there's so many people out there making fun of the quote-unquote millennial bag holders who are investing in Tesla. You go, millennials. I am happy for the people who made money on Tesla because you're proving these skeptics wrong. In my opinion, I'm an investor. I do dividend investing, but I respect all investors. Anyone out there putting their money at risk, investing in stocks, I will never put you down because I wish everyone success with their own unique strategies. My strategy is unique to me, but there's people out there literally putting down millennials, and I'm one of the oldest millennials there is. They're putting them down, saying, you're a millennial bag holder. You don't know what you're doing. You're just investing in Tesla. I commend those millennial investors who are doing really well in Tesla. And so all the naysayers and skeptics, why would you hate on other investors? It just doesn't make sense. Anyways, I did a whole video to that a long time ago. I'll link to it in the description below. I'm actually doing it OG style, wearing my Carl Kanai shirt. So you got to check that out. Big fan of Carl Kanai around here. All right. Check out that video. But anyways, I'll link to it in the pinned comment below. Too much to cover, but Spencer Dale, the chief economist at BP, did a whole study on peak oil, what's in the long-term future of oil, this and that. He explains much better than I can why oil for a long time here is probably going to be around to stay. And it will coexist with new inventions like battery operated vehicles and Tesla and solar panels and all of that, which is good. It's all an ecosystem. And so that's why I'm still comfortable buying energy. I don't want to overweight energy. I'm kind of don't have a huge energy exposure. I'd say reasonable. I don't want it to be too much bigger, but I could stand to up my energy position as a percentage of my portfolio by another 1 or 2%. And so I'm happy to added to BP already this year. I will add, in fact, I just added to Royal Dutch Shell as well, and I will probably add some more. And so I'm comfortable doing that. But check out the pinned comment. Really good analysis by BP's chief economist. All right, getting tired. Let's do the last one, Wells Fargo. I'm going to pop it on the screen right now. And so I was probably done with my stock purchases this week when I bought my Royal Dutch Shell, but something just told me this morning, Ian, just buy some more stock. Just do it. Something told me. It's kind of a little voice in my head. I don't know. Dividend investing. I bet you all out there feel that sometime. But I bought Wells third tranche at 47.76, starting yield 4.3%. Analyst estimates are up and to the right. Current PE or forward PE for 2020 is an 11. 2021 is a 10. They're growing the dividend really well, 7.8% per year. If they can keep that up, my dividend in 10 years' time will be a 4.33, and my hypothetical yield on cost in 10 years will be a 9.1%. And so, needless to say, I'm excited about adding Wells here. I'm even more excited because I have very limited exposure to financial services. One of the other financial stocks I own, Chubb, just announced good earnings and it's skyrocketing. And so, man, I'm glad I bought some. I'll add more because it needs to be bigger. But this is what I want to talk about, actually. I want to talk about this. So Chubb is a good example. And AbbVie is a good example. AbbVie is up in the 90s now. I don't want to buy AbbVie in the 90s. I bought in the 60s. I would have bought it all the way up to the high 80s. Not in the 90s. I'm done until it dips back into the 80s. But Chubb, it's gone up. I'll add more just because it's too under allocated. But this is it. This is something I really want to pinpoint in the video today. Two key lessons here. One, if you kind of have a stock and you really like it and you want to own it, at least the way I'm looking at it now is, Ian, just go do it. And so with Wells, I don't want to run the risk of it being an AbbVie and going up quicker than I can accumulate it. Thankfully, with AbbVie, I went in really heavy, really quick and built my full position, so I'm blessed. Chubb, not so much. Chubb was never a value, and so I was always just kind of dripping and averaging into it. And I'll still do it. But Chubb, I wasn't so fortunate as I was with AbbVie. I don't want Wells Fargo to be an AbbVie type situation where I haven't at least built like 3/4 of my position. And so what I started thinking is, because I was thinking, should I buy some Altria, for example? I was like, no, I got enough Altria. I've built Altria to a full size position. And so I just went for Wells. So that was one thing, one kind of insight. The other insight, though, I want to share is this concept. People ask me, Ian, do you really need 43 stocks? Yes, I do. The reason I have 43 stocks is I wasn't even going to buy anything today. The reason I bought something is the little voice in my head was thinking, Ian, Wells, you got to add to it. This is why I like these smaller positions like Wells and Chubb. I got them out there. I just don't feel good about having a small amount of money, having a small position. It makes the portfolio look messy. And so it compels me to invest more than I otherwise would. It keeps me focused. It keeps me in the game. And what I've always found dividend investing, stock picking is a big part of it for me, but I'm so good at the stock picking. And if I leave some money on the table because I'm over diversified, I'm okay doing that because by being over diversified, it allows me to get more money in the market. It puts that voice in my head, Ian, deploy more money. And what I found for me, at least in my situation, is it's the deploying the money that is more important than maybe maximizing my total returns, if you will. Now, don't get me wrong, my total returns are fabulous. I've done a whole analysis on this. I'll link in the description below. Slightly beating the S&P on the analysis I did, but with a much bigger dividend component, which is good because I plan to live off of dividends. But that's not the point. That's not the point. Like I said, for me, the point is cash flow. And what I've found is by having more stocks, it compels me to deploy more money. That said, I also have to be mindful not to deploy too much because I'm a family man. I've got to have a robust emergency fund, plan for all of that kind of good stuff as well. A lot of nuggets of wisdom out there, all. I hope it came through clearly because I am clearly tired. Late night, filming in the garage Friday night. Thank you for hanging in there. I love you all. If you enjoyed the video, please subscribe. Click the like button. Comment below. It is the best way you can repay me for this tireless work here on YouTube, but I do love it as well. I love you all. Wishing you all the best. Awesome weekend. In terms of full disclosure, I am long. I own the stocks mentioned today. I am long Cedar Fair, ticker symbol FUN. Wells Fargo, ticker symbol WFC. Royal Dutch Shell, ticker symbol RDS-A. PepsiCo, ticker symbol PEP. Starbucks, ticker symbol SBUX. AbbVie, ticker symbol ABBV. Altria, ticker symbol MO. BP, ticker symbol BP. And Chubb, ticker symbol CB. I own all of those in my personal dividend stock portfolio. Important, everyone. Market is hovering around all-time highs. There's a lot of risk out there. Dividend investing, stock market investing is not for everyone. It is possible to lose a ton of money investing in the stock market. So in terms of full disclosure, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey for fun and entertainment. I love you all. I will see you in the next dividend stock investing video.